Hey, good evening. How's everybody?
Good evening, Professor.
Good evening.
Good
How are you?
evening.
Hey, good evening. Alrighty. Um, okay, so let's see. I'm sharing my screen. So, oh, I need that anyway. I need that. So I see 8 people currently here in the collaborate. Uh, and let me quickly check how many are in our. So we have, only one more day left, right? 20 seconds. So basically, a little heads up. Let me first check how many are in the forum. So also 8 people, right? And no, announcement. So everybody's aware. I mean, this announcement, I believe, already went out today. Quiz 2 instruction went out yesterday. Final. So you have 2 exams. This is all. uh, all happening almost all at the same time. But what can I do? This is how it how tight it is. Summer 2 is really tight. Um, so I'm hoping to cover. Okay, so if we go into course material, we have only we have these 2 topics left. First, stock valuation, and so let me. I don't know if I have this one already downloaded or not. There is an Excel file. I'm sure I have it in my. Let me just to be sure. Let me download everything just in case. Okay. Download. I can't. I can't. Are you sure? Serious? Okay. Yeah, I guess it's downloaded. And then also. There's still a little bit more we need to do with the with what we did yesterday. It's getting slow again. So of course, Excel file is really important. I'll download that too. Oh, okay. Looks like it's all. Okay, just bear with me just a second, because I need to.
Hello, Professor. This is Eric speaking. I just wanted to
Yeah.
ask if you would be available to speak after class
Okay.
today.
Hold on. Okay. Can you? Yeah. Can you run it by me again? My head earphone was off. Uh, yeah. Go ahead, please. What was that?
No problem. I just wanted to ask if you'd be available to speak after class today.
Yeah, yeah. Just about, probably a few minutes. Yeah.
Okay, no problem.
Okay,
Thank
sure.
you,
Yeah,
Professor.
yeah. All right. I don't know why the volume is suddenly so low. I could barely hear you. Let me just adjust the volume. Oh, no wonder. Okay. I think I can hear you better now. All right, and then, okay, and this one is Excel. Let me just rename the file. Okay, so the files are there, so I can upload them. Alrighty, so I wanted to actually um, oh, I don't know why it's so slow again. Oh, okay. So yesterday, remember we found, oh, what happened? No wonder something's not right. The earbud is missing, so no wonder. Okay, so we found Apple's average monthly return, right? And Apple's, standard deviation, monthly return standard deviation, and the meaning of this. So, what is the meaning of this? Of course, this is the uh, expected return. So, because the meaning of the mean, think about it. Mean is something. Everything returns to the mean, right? Mean. I don't know if you are familiar with the concept of mean reversion, right? So, um, if the economy has, think about it. They say, uh, do you ever wonder why in all of my examples, most of my examples, do you ever wonder why uh, interest rates are generally 6%? Hmm? Uh, because it's the historical long run average interest rate, right? As long as the data exists, and even before the data existed, even in biblical time. I mean, there's no data, but some episodes, some from the Dead Sea Scroll and old papyrus, or in all those parched rolls, parched scrolls. Like in the old days, they roll on the parched skin of the lamb, right? And still roll. There are many uh, written records, not exact numerical data, but uh, in the written accounts, right? As long as the human race has had the writing system, the written accounts, anecdotes. Um, in those anecdotes, and written accounts, whenever the interest rate, whenever there's an anecdote about lending money, interest rate mentioned, most frequently, even in those days, was 6%. How do I? Well, even in those days, they thought 12% interest rate is uh, very onerous. 12% is almost, they thought 12% was, what do you call, like loan sharks. Because 12% means, 1% a year. I mean, 1% a month, right? So then, if it is, half percent a month, which is, then annually 6%, I guess historically people found that to be reasonable. And then, uh, so half percent a month, right? And then 6%, that would make it 6% a year. And uh, even after the days when we have the record of the data, interest rate data, right? The long-term mean, right, like over 100 years, 200 years, is like 6%. So compared to the historical average, we have lived in a very, very, very low interest rate era since 2008, right? And before 2008, it was about 3%. That was still somewhere between like 3 and 4%. That was still like, half the historical mean. So what does that mean? Uh, the interest rate will eventually revert to historical mean because uh, everything reverts to mean. Of course, we cannot use, think about it, if we have interest rate data for 100 years or 200 years, that doesn't necessarily point us to the immediate uh, future interest rate. And besides, um, think about it. 1980s, I mean, do we include, I mean, when we try to make uh, a forecast, do we include how many, what is the time frame we use? Generally, 5-year time frame for stocks. Uh, that's not very long term, but it's long enough. It's intermediate relatively, but think about it. If we Apple has been around for how many years? Apple has been around for 41 years. 1981. That's what. So if we take the average of monthly returns over 40 years, will it mean something to us? No. I mean, uh, it would probably be still about 2%. I don't know. I mean, because Apple has grown like 1,000 500 times, 1,700 times over 40 years, and we can probably annualize it, right? Uh, so holding period return is 1,700 times. 1,700 is like 100 1,700, so percentage, right? Uh, two more zeros. 17,000%. 17,000 or 170,000%. 170,000%, right? 170,000%. And you annualize it, right? Whatever. But whatever that long run average may be, and that long run average would be, I don't know, whatever it may be. It may not be directly, that's 40 years, right? Average over 40 years. That may not be directly um, relevant to uh, our immediate data. Okay, why do I have? That's weird. So now think about it. I'm gonna take you back to let's go back to Apple. No. That's just the major market. So you see, and extending it for maximum, right? Maximum range, then monthly. Okay. Um, those are when they had splits, and these are dividends. They and there was a period where between 1996 through 2012, right? Almost 14 years. Not 14 years, but like how many years? That's uh, yeah, 16 years. 19, if it is 1996, yeah, about 16 years, right? For a very extended period of time. There was a time when Apple didn't pay any dividends, right? Um, so what does that mean? During this time, Apple had this was a troubled time for Apple. Their iMac computers didn't do well, but I mean around this time, and since 2007 they took off again. And what happened in 2007? Um, iPhone, right? iPhone and what is that? iCloud Music, or I don't know. I'm not, I don't pay to listen to music, but look, Apple has Apple has had very exciting years since 2007 and 8, right? And until then, it was relatively very um, dull, right? Until then, it was very, uninteresting and dull. And only about from 2007, then they took off. So the average over 40 years will be a very neutral number. And it may not uh, immediately, it may not give us a clue uh, and for immediate future. Uh, and if we split the Apple's history in two parts, before 2007 and after 2007, then we will have a quite different mean between the two periods, right? Makes sense? So in other words, something like interest rate, yeah, a long-term mean uh, we can consider 6% as eventually. I mean, we may not get there anytime soon, but over probably over a decade, in about a decade's time, maybe 2 decades time, maybe. But when it comes to this much, shift in the mean, when it comes to this much, shift in the dynamics in the data, then we cannot use the long-term mean, like 40-year mean, as the expected return, but at least for the next 5 years, because we have used last 5 years. So at least for the next 5 years, this would be a good estimate or forecast for monthly returns. Okay. But it may not be the actual one. I would say a benchmark. So in other words, if the return, monthly return, actual monthly returns all deviate. They all deviate, from the mean, but eventually it will revert. I mean, if it is, one thing we can tell is if the return in July is 19%, we know it's not going to continue. It's going to come down, right? It will revert to the mean someday. And if a particular month, Apple's mean return was negative, right? In the worst month it was negative 18%. We know it's gonna revert to the mean. It's not gonna, in the long run, right? So the reason we are, the benefit we are getting from this is one. Where is that thing? Okay, I'll take you to the slide. Based on the normal distribution, so this is statistics. Come on. There is a 31% probability that the actual monthly return, will fall between 2%. I mean 3%. Our mean was like almost 3%, right? Between 3% and what was the standard deviation? The standard deviation was 9%. So 3%. Let's consider it 3%, 9%. So we can assign some probability. So actual mean next month, there's a 34% probability that the actual mean will fall between 3 and 12%, right? And that's one standard deviation above the mean. And also there's about 14% probability that the actual return will fall between 1 standard deviation and 2 standard deviation above the mean. So that would be, this is 12% and plus 9, this is 21%. 21%, right? The actual return may be somewhere between 12% and 21%, and the probability of that happening is 14%. And then above 2 standard deviations, so that's like above 2% return, the probability of earning such an extreme return of like above 21% is about, the probability is 2%, right? And that's the upper tail or right tail probability, and there are lower tail probabilities, and it's symmetrical, right? That's 3% and 9% below that would be negative 6%, so 34% probability that the actual return will be there. And there's also 14% probability that the actual return will be between negative 6 and negative 6 plus 9, so negative 15%, right? And there is also extremely low probability of 2% that the actual return will be below negative 18%. So we can predict it with probability. So, and then another benefit of knowing what is the standard deviation and mean is, suppose we do a very extensive stock search, and we do the stock search because we don't want to put our money to anything. First criteria is obvious. What stock has the highest return, highest expected return? In other words, mean return. Mean return this means expected return on stock I. I means, I is like N, any individual. I will be replaced by X when we are talking about X. If we are talking about the expected return or mean return of X, right? There will be expected return on X. And as for Y, this I will be replaced by Y. And when we're talking about stock Z, it will be. So mean return of X is 25%, mean return of Y is 30%, and then that of Z is 10%. So if we only think about the expected return, then Z is our guy. Isn't that right? Excuse me, my throat is so hurting, so let me, I'll have to take something. Yeah.
Is this?
Oh, can you hold it? Can you hold it? I have to take something because my throat is so painful. Just a second, okay? Okay, go ahead.
Yeah, is this monthly expected return, these percentages?
Yeah. No. I mean, it doesn't matter. I mean, it would be annual. I mean, from the sheer number, it would be annual. But it could be if it is monthly. Of course, this is wonderful, right? But let's say this is it's just an example. So let's say this is annual return, right? Still, even for annual return, 25, 30, that's great. If we go by only the expected return, then stock Y is definitely that's our guy, isn't it right? But that's not the only criteria. We need to think about the risk. Now think about it. The standard deviation is the risk because Standard deviation is what? Basically capturing, a standard deviation is the average swing, average, swing around the mean. Isn't it right? And that's why, I've been telling you, uh, uh, getting something below the mean, or obviously if it is like negative something, that's losing money, right? Return is, if return is negative, that's clearly not a good thing. So most people consider only the this is called downside risk, right? Literally, that is the risk of that's under, below the mean. So it's the mean is also the mean is, because mean being the forecast, right? Predicted projected return, and below that, that's why it's called downside risk, right? So most people consider only the downside risk as the risk, but upside risk, this is called upside risk. Upside is also a risk, and I've been telling you, suppose expected return was 3%, but you got, let's say, this is 9, this is 9% above it, so it's 12, and this is 21, another 9% above. Suppose you got something like this, 21%. And nobody would say that's a risk, but of course, it's clearly, it's a surprise. I mean, it is a surprise, but it's a pleasant surprise. It's not an unpleasant surprise, right? If you're here, if the actual return was like this, then that would be an unpleasant surprise. And but this is a pleasant surprise. Why is it a risk? It's although it's a surprise, but it's a pleasant surprise. Why is risk doesn't mean only a bad thing. Risk means also basically probability of uncertainty, right? Deviating from the mean, right? Probability of the uncertainty. That's the risk. Uncertainty is always the risk, isn't that right? So you should consider this like a driving. Suppose you bought a used car. And this is, you bought, you can buy a good used car, but let's say you got really a lemon. You paid like $2,000, but you really got a lemon. But you don't, because you're not a mechanic, and even if you're not a mechanic, guys like to work around the car, right? So some, at least, but if you drive, you would know. And let's say this is but unfortunately, you got a lemon. And what is the biggest risk? Well, of course, if you got a lemon, the first thing, brake won't work. If the brake doesn't work, it's right, clearly. But also another risk is steering. If the wheels are not steady, something's wrong with wheel alignment or balancing of the wheel. Something's wrong. The car doesn't stay straight. It doesn't stay on course. Even if you keep your hands on the wheel, right, firmly, holding it straight, it will swerve. It will, it will it will veer off from the straight course, right? And if it veers off, it doesn't matter whether it is left or right. If the car veers off, regardless of how firmly you're holding onto the steering wheel, that's a risk, isn't it right? So that, in that sense, that's why. So, and the standard deviation is average swing, right? Average of the that deviation. So you cannot only select a stock by this criteria. You have to also consider this, and this means Sigma, Greek character sigma. So what would the sigma stand for? S, so standard deviation. Okay. Now it's grown-ups language. I mean, Greek. If you use a lot of Greek, it's grown-ups way of all science, math. All science and math are expressed by equations, and all equations are in Greek. Alpha, all those coefficients and parameters are in Greek. Alpha, gamma, lambda, mu, and that's the grown-ups way of expressing ideas, right? So get used to it, right? Beta, alpha, gamma, all these, delta. And if you're not comfortable with it, you should make yourself comfortable with it. Isn't that right? You cannot stay a child forever. I mean, resisting, no, that's too difficult. I don't like it. I don't want. But then you will never grow, right? So you have to be, comfortable with the grown-ups way of thinking, and so if you're then looking at the standard deviation, x standard deviation x, sigma x is 40%, sigma y is 60%, sigma z is 15%. So going by the standard deviation, z is your guy, because the smaller the deviation, less risky, the less risky it is. And by that, y is the worst, right? Because that means this is the riskiest stuff. But then this conforms to the conventional wisdom. What's the conventional wisdom? No pains, no gains. Isn't that right? Without taking no risk, right? If you don't take risk, there's no good return. I mean, the higher the risk, the higher the return. So look, the higher the risk, the higher the return, right? So then, you're in a dilemma. You're in a dilemma. Why? If you go by this, then y is your best guy. But if you go by this, z is your guy. So how do you reconcile these two different criteria? So here comes the return risk ratio. What is the return risk ratio? Return risk ratio is, this is return or mean. So it's sometimes it's called, mean variance ratio, mean variance. Why? I mean, you might wonder, isn't it standard deviation, not variance? Shouldn't we call it mean standard deviation ratio? Yeah, sure, right. This is, mean standard deviation ratio. But if you think about it, standard deviation and variance are basically like twins. Isn't that right? They are like, twins, but not identical twins. One big twin and small twin, right? You might wonder, how can there be big twin and small? There was a movie in the old days, that was 1990s, Arnold Schwarzenegger and Danny DeVito were twins. They're not identical, fraternal twins. So one is very big, the other one is small. But think about it. Variance and standard deviation are like fraternal twins, right? So you can say, mean variance ratio. Sometimes they really use variance. But what is the meaning of mean variance ratio or, return risk ratio? It's obvious, It's like gas mileage. It's output to input ratio. Didn't I talk about gas mileage before? Didn't I discuss the output to input ratio before? Hmm? What is the output to input ratio? Um, Gas mileage is a very good example. Okay. Uh, Basically, if you measure output to input ratio, okay, I'm not using touchscreen right now, so I have to. Uh, it's a little awkward, but but think about it. Output to input ratio is uh, it measures productivity. It measures productivity, isn't it right? For given input, uh, how much output do we get? So one good example is gas mileage. Okay, what is gas mileage? Gas mileage is exactly output to input ratio. Think about it. How many miles? Miles driven, right? So you fill up your gas tank, right? And let's say 20 gallons, in the tank. I mean, that's a huge, big car. Usually small cars, I think about 13 gallons max, small cars. And medium-sized cars, like they have about 16, 18, 15, 16 gallon tank. If you have, like 18, 20 gallon tank, that would be a huge car, big car, really. So you fill up, like 20 gallons in the tank and drive until you run out. And if it is 30, and let's say you got, 600 miles for 20 gallons, then the mileage is 30. Isn't that right? But let's say with only 10 gallons, you put 10 gallons, uh, just filled, 10 gallons, and you got 600 miles. Then, of course, then the mileage is 60. Then gas mileage is 60. So what does this mean? A car with higher gas mileage is obviously more productive car, or more fuel efficient or fuel economical car than the car that gets only 30 miles. 30 miles is already good, very good, But because most medium-sized to big cars get just about 25 miles on the highway. So if it gets 30 miles on the highway, that's wonderful. But anyway, that's in output to input ratio. Then think about it. It's the same idea. Mean return, or the expected return, that's the output. Oh, yeah. And the standard deviation is the input. So in other words, this is the risk you take. Input, it's an input. You have to input something. You have to give something, right? Which is, the risk you're taking. You have to give something. In other words, you have to take the risk. It's not for free. You have to take the risk and return for the risk. So obviously, if this ratio is higher, just like the gas mileage, the higher the ratio, the better it is. Right? Make sense? If someone, don't do this because, as I said, fuel efficiency. But say, because I can't see, right? I had to come back to this. Uh, uh, but while I was on this, I can't see what's going on in the chat box. Okay, so please say that. So then, our answer is obvious. Okay, we take the return risk ratio, whichever has the highest return risk ratio, that's our guy. And according to this, Z is our best. Z is the best, right? Stock Z is our, best guy. It gives us the highest gas mileage. Okay, gives us the highest mileage. But in the book, the textbook talks about coefficient of variation. Coefficient of variation. What is that? Coefficient of variation is the inverse or the reciprocal, exactly the reciprocal of return risk ratio. And the reciprocal means, then, the lower the number, the better it is, the lower the number. So, then you might wonder, why do they use, it's not very intuitive. I mean, you would want the higher the number. Yeah, I like this, but in the U.S., think about it. In the U.S., gas mileage is basically how many miles per gallon. That's gas mileage, right? But in most other countries, it's how many liters per kilometer. Can you imagine that? They use inverse gas mileage. It's not only, I've been to South Korea, I've been to Western Europe, France, Germany, Italy, Spain, Czechoslovakia, and Hungary, Austria, all over. Gas mileage is, the reciprocal of U.S. They use, why? And you scratch your head. Why do they use, that doesn't seem very intuitive. But it makes sense too. Why? Because in those countries, gas is very expensive because they are not oil producers. U.S. produces oil. Actually, U.S. has a lot of oil. And, gas price in the early 2000s was very low. I mean, in the 1990s, not to mention, 1980s, but, early, like 91. In 91, the lowest, I remember the lowest gas price I ever saw was back in 1991. And at the time, it was 87, the lowest gas price I remember was 87 cents per gallon. 87 cents per gallon. And why? Because U.S. didn't have to worry about supply of oil. I mean, U.S. is an oil producer. It's simply they are not doing that because they're U.S. We are preserving our own oil reserve because it's cheaper to import. And as long as it's cheaper, then we import. And if Saudi Arabia runs out of oil, someday they will run out. All those OPEC countries will run out of oil. U.S. will still have oil because we haven't tapped into it for a long time. And even not only offshore, right? What they call shale gas and shale oil in the offshore. Not only that, but also even inland, in mainland, fracking. Pennsylvania, they have a lot of oil rigs, and it's fracking, through fracking. But they don't do it because it's costly and it's, environmentally not good. They don't do it anymore. But if it is cheaper, they will, obviously, and if it is environmentally not, now think about it, if they, I'm sure it has environmental impact. But anyway, but in the countries that don't produce oil, they have to import oil, and it's very expensive. And if we all experienced, I mean, recently, when oil supply went down because of the cargo because of the supply chain disruption, or supply bottleneck, right? Um, the import was uh, the amount of import was smaller than before, and of course it's more expensive. Um, so from those countries' perspective, the countries that don't have any oil, the inverse gas mileage is more intuitive, right? So if that's the case, the smaller the number, the better it is. Smaller the number, the smaller the number, the better it is. So that's exactly that. The book talks about coefficient of variation. And in the quiz two, I believe there's a question about this as well. So keep in mind what they are asking. It's not this, because the book is using this concept, which is simply the reciprocal. So then we still come to the same ranking. I mean, either we use this or use this. Still, z is number 1, x is number 2, right? Y is number 3. Okay. All right. So we're not. The rest of this we're gonna come back after stock valuation. This will be like part 2 of part 2 of what? Risk and return. Part 2 will come back. And so let me open then. I think I already downloaded. Okay, let me open that. Maybe it can't. I think I'll have to open it for you. Please open. I think it's taking so much time. Yes, we did. Because the gas price was soaring, and to relieve some burden on the gas price, they tapped into our oil reserve. But reserve means what we have in store, what we have what we are holding in store, right? Reserve. It's not like digging up oil from the oil rig, right? Digging up oil from the oil rig. Yeah, the oil reserve underground, that's also oil reserve. But the reserve that you're talking about here is the oil reserve in the refinery that oil companies are holding, or the government is holding for what they call strategic oil, right? Or something that they are storing, having it in case we have sudden nuclear winter, or right, by climate change, suddenly the winter is unexpectedly cold, we might need to tap into those, strategic oil. Uh, okay, I've been waiting for this file to open, but okay, so what's going on? It's I'm having so much time. Welcome to Google. It takes so much time. Okay, since it is taking so much time, let me try again. Just try. Oh, no, wait. Okay, it closed. So let me open it with. Nothing's happening. Okay. What time? So stocks are classified. Stocks fall into two categories. One, common stock and preferred stock. Actually, preferred stock sounds like a good thing, but no. Common stock is, the real deal. Preferred stock, it has its own advantages, but that's not the main game. We'll talk about preferred stock later, but common stock is the true ownership. Okay, so this part, that's just verbiage. So institutional side, institutional aspect. So I'm not gonna spend too much time on it. Institutional aspect, anybody can just read it up. Um, Preferred stock is often considered quasi-debt, almost uh, debt, because much like interest on debt, it specifies a fixed periodic payment. In other words, uh, just like interest on the debt, right? Uh, Preferred stock pays fixed dividend, fixed. So fixed dividend is like that, like this. So preferred stock has a par value. Par value is different, in stock. Concept of par value is completely different. Uh, why? Because remember, par value in bond is maturity value, right? The face value or the maturity value, redemption value, par value, and it's $1,000, right? That's what you get at maturity. That's the par value in bond. But in stock, par value means IPO price. In other words, the price that the stock was, sold at for the first time in the primary market, right? So just like in case of bond, if the coupon rate is 10%, that means 10% of par value 1,000, right? So every year you get $100, and every 6 months, $50, right? 50, so 100. But in case of preferred stock, if it is 10% of the par value, and the par value can be like $20, because it's IPO price, it could be $60, whatever. But preferred stock generally. So let's say if it is 20, then 10% That means what? Annually $2. And they pay dividends quarterly. So what does that mean? Every quarterly, 25 cents, right? 25 cents. So that's, and it's fixed. So regardless of, actual uh, earnings, because dividends are supposed to come out of the earnings, or EAT, or net profit, but that's the dividend in case of common stock. So in principle, dividend of the common stock is supposed to, in theory, supposed to vary with the earnings, actual earnings, but in reality, it really doesn't. It just it's a predetermined amount based on the expected uh, profit, expected earnings. Um, but at least it will change, because expected earnings will change. It changes. But in case of preferred stock, there is no change. It doesn't depend on the dividend. It doesn't depend on the earnings. Okay, it doesn't depend on the dividend. It will just be uh, preset. And because they have fixed claim on firm's income, that takes precedence over the claim of common. So that means there is no dividend to the common stock before paying dividend to the preferred stock. Okay, that's the only reason it's called preferred. But otherwise, as I said, there's it's not, because it doesn't come with any ownership. Preferred stock doesn't come with any ownership. Uh, of course, it doesn't matter. I mean, I'm a Google shareholder, I'm Apple shareholder, I'm Amazon shareholder, but I don't care if I have voting right or not. I get this, I get this notice, every once in a while, there's, please, board meeting, please, vote for directors, something like that, I don't have time to do that every time. I mean, you can vote online easily, but board of directors, all these people, I don't know. And if I don't know if they have been doing a good job, or if Amazon has been doing well, Apple has been doing well, I'll just vote for them if I were to vote. But even if I don't vote, they will still remain on the board, because I have only like max 100 shares at best, at most. Those people already have, like they are already, the fact that the reason that they are on the board of directors is because they are majority shareholders. They have like at least 5%, 7%, sometimes 10%. With their own votes, they can still be remain on in that position. Um, so anyway, preferred stocks are not normally given a voting right, although preferred stockholders sometimes allowed to elect one member of the board of directors. Okay, so this is institutional aspect. So not very interesting. Restrictive covenants, may include provisions about passing. So some preferred stocks can pass up the dividends. And of course, you cannot pay dividends if you don't have any income, profit. If you don't have any profit, remember previously, we looked at Apple, and I told you there was a long period in Apple's history when they stopped paying dividends. And why? Because when the company is in trouble, I mean, a company is not making profit, there's no way you can pay dividends. And even if you're making meager profit, all that meager profit must go first to reinvest, right? Reinvest in the growth of the company. There is no there's no room, or there's no latitude uh, to pay dividend, right? There's no room for this company to pay dividend. All the profit must uh, straight be plowed back, straight back into the company. So yeah, that coincided with Apple's troubled time between 1996 and 2007. So that was almost 10 years actually, right? Although they resumed paying dividend from 2012, but until like troubled time for Apple was like between this 96 and 2007, right? Um, where was I? No, this is not it. Where did I? Was it this? Yeah. Okay. Um, so if they don't have any EAT or net profit, they cannot pay out dividends. Then they will pass up. They will pass up the dividends, right? They will pass up the dividends, and then when they are making a profit again, then they will resume paying the dividend. But then there are two types. One is non-cumulative, and the other one is cumulative. Cumulative means, cumulative preferred stock means they pay all the accumulated dividends unpaid so far first, right? That's why it's called cumulative. Uh, so in the meantime, the dividends were held in arrears. Okay, if you're asking a question, please say uh, just speak up, okay? Because as I said, I cannot see. I hear this ding ding all the time, but I can't see it, now because my screen is fully taken up by this slide. Okay.
Professor,
Yes.
that ping is just people coming in and out of the room.
Oh, okay. All right. Thank you for letting me know. Okay, but sometimes there's, no. Sometimes it sounds like somebody's, when I hear that ping, it's like someone left a line in the chat box or something. Okay. Thanks for reminding me. Where was I? So, the passed up dividends are held in arrears, right? Held back. And cumulative, they pay. Non-cumulative, it's gone. Okay? And you remember a call bond, just like that. Some preferred stock has callable feature. Okay? Now, so I think this is a good time to take a break. So we'll take a 10-minute break and come back at 22, right? Uh, and then we'll start from IPO, going public. Okay. All right, 10 minutes.
Yeah, I got a question.
All right, we're back. We're back. So looks like someone asked a question. Uh, Jesus Martinez. Jesus, are you here?
Yeah.
Okay, so it looks like you uh, dropped this line, in the chat box. Look, yes, they can, even if they are not, currently making any profit, they can still pay out dividends. From what? From the retained earnings. Remember retained earnings, right? The company has made a lot of retained. First of all, from EAT, from net profit, if they pay out dividends, after paying out dividends, what they plow back into the company is retained earnings. Okay, if they don't pay out any dividends, the entire EAT is retained earnings, right? Retained, and then what do they do with that? Normally, growth firms, uh, they need to reinvest it for growth because they are growth, like Apple when they were in the early 2000s. They were growing fast. So growth firms need every penny, right, to be reinvested in their own growth. But mature farms, AMC, I would say, is a mature farm. What is a mature farm? Mature farms generally don't have much room for growth, right? And especially in the AMC is basically AMC is a theater, and it's a brick and mortar business. And before the age of internet, and before the age of YouTube, and uh, already they met their saturation. I mean, mature phones are mature in the sense that their market is already saturated. The market, so their market share doesn't have much room for growth. And then, but until then, think about it. Coke and Pepsi is a good example. Coke and Pepsi are a good example of also a mature farm because geographically, in terms of geographic market, they have no room for growth. I mean, where in the world don't they have Coke? Right? Where in the world? Even Afghanistan, I guess they have. I mean, they probably have banned it after they took over. It's not like Taliban took over. U.S. left, and the vacuum was picked up by Taliban. Right? It's not like they. Some people think, especially those, Trump supporters, think, we were driven out of Afghanistan by Taliban. No, actually, and so they put the blame on Biden. Uh, but then think about it. We just uh, it's harsh to say, but we abandoned Afghanistan because it's hopeless. I mean, it's just a war of attrition. It's like a bottomless pit. You just pour money into it. I mean, if they can just pick up themselves, from the ashes, and unlike South Korea after Korean War, uh, they picked up themselves, and they made themselves into the one of the largest, 10th largest economy in the world, making high tech products. But there is no vision like that in Afghanistan. So it's harsh to say, but U.S. couldn't dump money, throw money, down the flush the money down the toilet. So we left. And then the vacuum, there was vacuum. So U.S. military left. There's vacuum. So it's easy for Taliban to pick it up. It's a different story, but then Maybe they have banned, Coca-Cola, whatever it is. But even in North Korea, there would be not for average North Korean people because they live like slaves, but for uh, foreigners, like there are diplomats, right? Foreign diplomats, uh, some foreign business people, uh, some tourists, very limited to a limited scale because their tourism is basically supervised, 100% supervised. You can the communist guys, uh, so-called, directors are onto the organized tour team and watching every move. You don't go there. You can't go there. You can't. um, so, but everywhere in the world, there's Coca-Cola is even in South Pole in the research basis. They have a vending machine. But so, what what room is there for Coke to grow in terms of geographic? They are mature companies. Mature companies have a lot of retained earnings, and then because they don't have uh, much growth to be expected, um, they they actually pay out dividends, right? To relieve the burden, to relieve the tax burden. Actually, they kind of pass the tax burden onto the shareholders by unloading a lot of retained earnings. Now, in case of, but still, Coke is making money. They are not losing. They are making profit. Coke is making profit still because it's a cash cow. The business is cash cow basically. But if AMC was losing money, uh, but they paid out dividends, right? Why do they do that? Of course, if it is preferred stock, it's an obligation, just like interest on the debt. You have to pay dividends. It's an obligation. So
They did it kind of weird, actually. They released a whole new stock, and they said that
mhm.
that was the dividend. The preferred shares, like
Yeah,
on
yeah,
the
yeah, yeah,
ticker.
yeah, yeah, yeah. They do. Instead of cash dividends, it's also possible. There are cash dividends and also stock dividends. They can pay dividends in stock. Uh, they can also pay dividends in kind. In other words, in merchandise, in kind. Um, uh, but again, maybe if they pay dividends in additional stocks, that's they wanted to preserve cash. Uh, but again, if they have if they are it's a mature company and if they have a lot of retained earnings and they don't want to, I don't think they are in a position to really disperse cash because AMC is theaters are almost like a uh, sunset phase. I mean, who goes to the movies to actually? Somewhere still some people are going to the movies, but you can watch movie on your own uh, computer. Uh, and since the pandemic, the theaters were hit hard because you can't go to the movies. It's a closed space, right? And so obviously they are not in a position to disperse cash, even if they have good retained earnings, because they have to hunker down. So they must have paid, dividends through additional shares. But that's not a good thing. If you pay dividends in additional shares, that's actually diluting the share price. It will dilute the share price. I'm going to get to that later. Um, but as I said, if they pay out dividends, uh, it's a signal. I mean, a company that is not making a lot of profit, a company that is not um, growing, uh, how can they pay dividends? I mean, they're not, the profit is not even good. How can they? It's all signal. They are sending out signal that they are good. They have good cash flow. So it's a false signal, actually. If you think about it, it's a false signal. But why do they send out such a signal? To maintain their stock price. Because if they don't send out such a signal, then the stock price will go down. They will have to. So one of the two things they have to do. Either they have to buy back their own shares, stock buyback. That will keep the price up, or send out positive signal, right? Okay, so that took a lot of time. It's 7:30 already, 6. So let me get back to wasn't it this? I think where was it? Where was I think was it this? No. Yeah, it is this. So going public means selling stock for the first time. Okay, in the market. So when a firm wishes to sell its stock in the primary market, I explained this before. Primary market, for the primary market exists only once in the life of any asset, right? For the first time, and the transaction is between the company and the first round of buyers, and after that, everything is secondary market. Because in the secondary market, then the transaction happens between the buyer and seller. In other words, investors, not between the company and the investors. Okay. So it has three options: a public offering, in which it offers its shares for sale to the general public; a rights offering, in which new shares are sold to the existing shareholders; a private placement, in which firms sells new securities directly to an investor or group of investors. Now we're going to talk about only IPO, public offering, initial public offering, right? So IPOs are typically made by a small, fast-growing companies that either require additional capital to continue and have met a milestone for going public that was established in a contract to obtain venture capital funding. So think about it. All startups lack funds, right? Because they are startups. I've been telling you, in principle and in theory, if you start up a computer, some manufacturing, in principle and in theory, there are two ways to raise capital. One, selling stocks; two, selling bonds or borrowing. Selling bonds is borrowing money. But look, how can you sell stocks and bonds if you are a startup? That's you understand? It's a catch-22 question, isn't it right? It's like, to open a credit card, you need to have a credit history. But you don't have a credit card. That's why you want to open a credit card for the first time. Then how can you have a credit history? Isn't it right? This is really absurd. You must have, because you guys are about 18, 19, 20. So first time opening a credit card. This was the frustrating situation you probably have met. Of course, you can open a bank account and deposit like $2,000 or $5,000, and the credit, you can get a credit card, and the limit is the credit card limit is right only the limit your amount of your balance in the bank deposit in the bank. You start like that, of course. But that's almost like a debit card, isn't it right? It's not a credit card. It's practically a debit card. If you can only use the card only up to the maximum deposit you have in the bank, that's a debit card, actually, right? But that's really a catch-22 question, right? You don't have a credit card, so you want to open a credit card, but then they require credit history. You don't have a credit history, so you cannot open a credit card. Then you won't have a credit history. You won't be able to open a credit card. So it's like that. You're a startup. You have no track record, so you cannot borrow money from the bank. You don't have any assets, You can't borrow money from the bank. Of course, there is, a small business loan, and still, if it is a startup based on your, a brilliant idea, if at least if you have a patent, you can use patent as the collateral. But you don't have a patent. Think about it. Do you think Steve Jobs had a patent when he started Apple? Do you think Bill Gates had a patent when he founded Microsoft? They just started building, assembling PCs from their father's garage. That's it. And so. And you cannot sell stocks because you're just a startup. You are not even admitted. You are not even accepted in the stock market. So this is, obviously, like, credit card, opening a credit card. Now, so somehow, if you can sell your idea to a venture capital, and the venture capitals generally. So how do you sell your idea to venture capital? You can, knock on their door. Actually, you can go present yourself, and this is what or there are trade fairs. Trade fairs. There is CCOM or CONSECOM or I forgot. Electronics and softwares. And every year there are trade fairs, and there you register and open a booth, and from there you introduce your company and then your business model, and those places venture capitals always flock to those events. So I don't know if you've and venture capital so so you were able to get invested by venture capital, but they don't invest their money for free. Of course, they invest $5 million, and in exchange they demand 50,000 shares or 500,000 shares. And then why? Because when it's time to go public, then and if IPO prices, so think about it. If you invested $5 million and got 500,000 shares, each share is $10, on the book. And this is a company that is not yet traded publicly. So your shares are only between you and the venture capital. Nobody, in the market, nobody buys, nobody even, knows about you. Nobody cares about you. But once the IPO is launched, once you're, and then if at IPO the price goes up to, let's say IPO price is, $50. I mean, even at IPO price, that alone, opening price, this venture capital makes 500% return already. Now then, at the end of the day, at the closing of the market, the price was $100, right? Closing price $100. The venture capital is making 1,000% return. Well, that's why they invest, okay? To do. I believe Facebook was like $60 when it was, at IPO. I still remember that was like back in 2010, I guess it was 2010 or 2012, and then IPO price was at the closing of the market, I guess something like $60. I don't know, but that was about it. And now, how much is Facebook? You can look up. Then investment banker, that's where the investment bank comes into play, right? Because investment bank is like acting as a broker for IPO. The role of the investment bank, underwriting. What's underwriting? It's like suppose you are going public, you're a startup and you're going public, and you want to raise, $10 billion. Oh, $10 billion is very, uh, um, ambitious, right? I'm just giving you the rough, picture. The actual picture, actual process may be, more detailed and slightly, more, complex. But just the idea to give you the idea. Uh, Target capital to raise 10 billion, right? Then is it achievable? I mean, it's realistic, and of course, investment bank will analyze and evaluate the whole situation, and it's doable. Let's say, so then what should be the price? The price, let's say $100. IPO price $100 per share. Then how many shares to sell? Of course, we know then 10 billion divided by 100 shares, that would be like 100 million shares, right? That's a lot, 100 million shares. Okay, but then how do you guarantee that 100 million, all of this can be sold? There's no guarantee. But one, if there's no guarantee, then this 10 billion is not guaranteed. Nobody can guarantee that 10 billion, right? Isn't that right? Where is my okay? Nobody can guarantee that. So it's like the lawyers can never guarantee that they can win. No, they will just say we'll do our best. Isn't that right? Lawyers cannot, but they still keep the money. I mean, even if they lose or win, they still keep the money, right? So first thing is they can say we'll do our best. That's called best effort agreement. Best effort agreement. Best effort. We're not interested in that. We don't want best effort agreement. It's very irresponsible. Lawyers are very irresponsible in saying that we'll do our best, but then they lose, and you lose your money, and you lose the case. But what we are interested in is underwriting. What's underwriting? Okay, so they say underwriting. We'll do our best, but we'll try our best, but since there's no guarantee that this can be achieved, how about we do this? I'll pay you. Give me all 100 million shares. I will buy 100 million shares from you for $80. $80. So $80 times 100 million will be 8 billion, right? Will be 8 billion. And then what they say is, so they pay you 8 billion. Investment bank pays you 8 billion. So you have secured 8 billion. I mean, you receive 8 billion. It's guaranteed. No matter. I mean, it's cash, 8 billion. Although that's not 10 billion, doesn't matter. 8 billion. I mean, you are a startup. You didn't have any. You had $5 million. That was all your equity. Now your equity is 8 billion. So it doesn't really matter whether this 10 billion is achieved or not. But then why did the investment bank do this? Now the investment bank will sell this for $100. So what does that mean? If they sell all of this 100 million shares, they make 2 billion. Investment bank makes 2 billion. This is called, this difference of $20, that's called underwriting discount. This two, right? $20, that's underwriting discount. So this is what they make per share, and with 100 million shares. So that's why they want to do, throughout 1990s, during the dot-com bubble, so many startups went public, even if they didn't have any staying power. You must have staying power. I mean, after IPO, that's fine, and in IPO you made big buck. I mean, if you, the thing is, if you cash it out right away, good. But some of those startups were really young people with just bright ideas, good ideas, So, but then because they thought this business is themselves, they don't sell the stock, they don't sell the shares that they had, because if they sell the shares, then they have no stake in the company. I mean, they become outsiders. Then they just, like, think about it. If you start up a food truck and without the passion for your cooking, you cannot be successful with the food truck. Of course, passion means also not just the passion, but you have to be talented. I mean, you have to really cook up something that is really tasty. Otherwise, just passion alone doesn't make you a successful food truck owner. But think about it. You think this food truck is you? I mean, you are personification of your persona, or your spirit, or what. But then this food truck goes public because investment bank was sweet talking to you. But then everyone who invested in this IPO sold their shares, sold off and cashed in, and then they, but what happens, if they all sell off right after IPO? If they all sell off, so on the day of IPO, the opening price was like $50, and end of the day, it's $200. Wow, then they all sell off. The next day, price falls drastically, and you are the food truck guy. You're not the one who will sell this share, because if you sell this all your shares, then you have nothing to do with the food truck business. So you don't, because then people who started up that business, actually they all fail because it's not their fault. But the company cannot go on anymore because the stock price plummets to zero, and there's no working capital. You cannot even operate from day to day. But anyway, this is what underwriting is, and to make it happen, what they do is now think about it. Selling 100 million shares is not an easy thing. So what do? They form a syndicate. Right? Syndicate is underwriting. So there is an issuing firm. Underwriting syndicate is one investment bank allied with other investment banks, right? The original investment bank that floated this idea is called Originating House, and each investment bank is one investment bank has a lot of brokerage firms that they are dealing with, right? Brokerage firms, So think about it. Brokerage firms are at the forefront of sale of stocks, right? Because people generally, buy stocks or trade stocks through the brokerage houses. You have to have your account with the brokerage firms. So, and each of the investment banks have, brokerage houses that they are dealing with. So under this investment bank, there's selling group, brokerage houses. Under this one also a number of brokerage firms, another selling group. So think about it. You have, in other words, tentacles, like an octopus with tentacles. You have a lot of you can branch out into actual windows that interface with the actual investors, right? This way, they sell, maybe not all 100 million shares, but close to 100 million shares, right? That's all. So that's what IPO is, right? I didn't want to spend too much time on this because what's more important is the stock valuation models. So I don't think we can go over everything, but there are 4 stock valuation models. First, so institutional aspect is over. Okay, and I'm not interested in institutional aspects because it's an interesting part too. For example, especially the ownership control, right? But basically, I'm more interested in the mathematical aspects. So the optimal portfolio weight, and things like that. Minimum variance, portfolio, and etc. These things. So all stock valuation models are basically a kind of discounted cash flow model. You all understand what discounted cash flow model is, because bond valuation model is discounted cash flow model because you're discounting all the future cash flow, right? This is present value, a kind of present value. So think about it. So 4 models. First one is called zero growth model or constant dividend model. Okay, S0, S stands for stock, but I would for intrinsic value, I would use V value, right? V0. Think about it. It is all, basically discounting present value. Second model is constant growth model or golden growth model. Third model, variable dividend growth model. So everything is dividend, because think about it. In stocks, future cash flow is dividend, right? Future cash flow is dividend. And unlike bond, in case of bond, future cash flow is all coupon interest and the face value at maturity. But think about it. Stocks don't have maturity. Stocks go on forever. So unless you have a specific timeline, okay? So let's say you hold this stock and you are going to sell this stock 2 years from now. Unless you have a specific timeline, you don't. The future value of the stock becomes irrelevant, right? Why? What did I do? Why do I? Okay. Something's not right. I mean, why is it? Okay, let's say, so I think I will have to, okay, you will see a little reconfiguration of the little reconfiguration of the screen. Because I'll have to use the okay, come on. Okay, there you go. So, think about it. Stock price, I will use V0, which is present value. We all understand, oh, it's going to be, dividend, first dividend, discounted, right? The second dividend will be discounted twice. And then this goes on forever. This will have to go on forever, isn't it right? Unless, in other words, unless the company shuts down at some point, right? Anyway, why would, unless it fails, or we don't know. I mean, think about it. Amazon, will it fail? I don't know. Someday, 1,000 years later, and I don't live 1,000 years. It's totally out of my. 200 years later, Apple. What about Apple? Is it gonna? But as long as the, as long as there is still, they are making something that is still, in demand, they will go on, right? They will go on. So you can assume that the company will go on forever unless they shut down of their own accord or of their own volition, right? And think about it. Infinite future, let's say there is, dividend in infinite future, and there is, also price of that, not future value, but the price of the stock in the infinite future. What do you think is the value of this? What do you think is the value of this? This will be insignificant. Not insignificant. In other words, not infinity, but infinity is not insignificant. Infinity is very significant. Close to zero, right? Why? Because this future value of the stock in infinite future will still be a finite number, right? You understand? It's not going to be an infinitely large number. Do you think Apple's going to be like, $1 million in 1,000 years?
No.
No. Why not? Do you think Google will be $1 million in 1,000 years? Do you think Amazon will be $1 million in 1,000 years? No. Why not? You just what happened to Google and Apple. Google and Amazon and Google were both about $2,300, $400, June and July, and then what? They split. Why did they split? Because $2,400 is onerous. It lowers the marketability. Think about it. If I have $3,000, right? I want to buy Google, but I can buy only one share. Not even two shares, one share. And $700, with the $700, I cannot, I will still have to keep it in cash. Or find a stock that is, probably, $100, and I can buy 7. But if Google is $100, with $3,000, I can buy 30 shares. In other words, the marketability goes up when they split, right? And think about it. If Google is like $2,500, I can buy only one share. And when I need with $3,000, I can buy only one share. And if I need, urgently $1,000, I cannot cash it out. I mean, I can cash it out. I have to sell the stock for 2,500 just because of the urgent cash of 1,000 I need. Then I give up. I forego all the dividends, all the potential dividends that Google could have paid me or Amazon could have paid me. Right? This lowers the marketability. You understand? So that's why they split. And if they split, then with $3,000, I can buy 30 of them. And if I need $1,000 urgently, I can just simply cash out $1,000 and keep the other $2,000 in Google and still, continue to earn dividends. Right? Makes sense? There are two reasons. One is because of the split. This price won't be infinite. It's not going to be an infinity. Even in infinite future, it will be a finite number. However, 1 plus r raised to infinity will be an infinity. Right? Will be an infinity. So you divide a finite number by an infinity, it will become close to zero. So it drops out. It's almost insignificant. Of course, the same thing with this. So that's why it's called dividend discount model, right? And dividend discount model is a subset of discounted cash flow model because you're discounting cash flow, right? I said there are two reasons why this is not gonna be an infinitely large number. One is, of course, stock split. Two, business cycle. Business cycle. Boom and bust. Think about it. During the boom, I mean, when the economy is good, expanding, price of everything will go up, right? Stocks will benefit from this expansion. But when it goes down, most of the stocks will also lose value, right? Interest rate goes up. I mean, when the economy is overheated this stage, what happens? They raise the interest rate to cool off the economy. When interest rate goes up, the valuation suffers, right? So all these cycles will, that would be the second reason. I mean, in million years, how many cycles? I don't know. There will be, in million years at least, 100,000 cycles maybe, but because of that, right? So that's, I guess that's all the time we have for today. That's all the time we have. So okay, so that's it for today, and we have just one more day left. So I hope to see everybody on Monday. Okay. And don't forget the quiz 2 and final, right? Everything. I'm afraid, I'm sorry to give you all these things all at this, but that's the timeline we have. And there's nothing I can do about it. It has to be done all in a in a crunch like that. All right. So see you guys all. Have a great evening. Okay. So I'll stop recording. Take care, everyone. All right, you're welcome. Take care now.
Okay,
Bye-bye.
thank you, Professor.
All right, take care. All right, take care. So I'll stop recording. And I remember someone said